Hey there, Ken Calcutt here with Cornerstone Financial Management. It's the day after Labor Day. I hope everyone had a good holiday and enjoyed some rest and relaxation. I want to give you guys a quick update on what's going on with the markets. I'm going to start with what I usually start with. This is the S&P 500 chart, just a general, picture of what the market's been doing this year. If you guys remember, this was the big drop we saw back in the first quarter. April was our low point. This was all of the fear and concern around tariffs. That has generally subsided, so we've seen the market rally from April to now pretty substantially. This is roughly 25-30% rally since April, which is a pretty big rally, which tells us the market and investors in general are less and less concerned with the impact of tariffs. Now, there's still potential there, but it's not as scary, I guess, as it was back here. So we've seen this big rally. The S&P year-to-date, as of today, I think it's up about 8% year-to-date. Started off pretty ugly. Right now it's looking pretty good. And so where it goes from here, of course, we can't know for sure, but I would not be surprised if we see a little bit of a pullback here. This solid green line will be a pretty logical level for it to drop to. That's pretty normal for September, October. The market can be kind of choppy in the third quarter, so I wouldn't be surprised if we see that here in the next 6 weeks. So a little dip would be okay. Probably a healthy thing for the market, honestly, because it's gone straight up for so long. We kind of need a little break. And then hopefully fourth quarter resume some growth. Now I'm going to jump over to another page and talk about some factors that are influencing where this is moving. So hang with us just a second. Okay, so here are some factors that I think are very important in dictating where the market goes from here. I'm going to run through these just to give you guys an idea of what's causing the movement. The jobs and unemployment, I think this is a key factor that points out the health of the economy. If the jobless claims stay at a reasonable level and new jobs created at a reasonable level each month, I think the economy is holding up well and we're probably in decent shape. So far, that's been good. There are question marks around this one. Those that think tariffs are going to be a problem, they think these numbers are going to start getting bad, okay? Unemployment's going to go up, new jobs created is going to go down. That's a sign that the economy is slowing down or already slowed down. This is a question mark. If this holds up well, then I think the economy's fine. If these numbers start getting shaky, maybe we're slowing down. All right, inflation. So far, this is holding up okay. Also a question mark. Inflation is still in the mid-twos. If you'll remember, this has been going on since 2022. The Fed's trying to get inflation down to 2%. We're in the mid-twos, 2.4, 2.6, something like that. Again, more concern here, lingering concern that tariffs are going to cause inflation to go higher. So far, that hasn't really happened, maybe a point or two, but nothing noticeable. But there's still those that believe that it's yet to show up, that it's still going to show up, inflation is going to go up. I don't necessarily believe that. I think if it goes up, it'll be very modest, but we don't know. So this is a question mark. So far, it's holding up nicely, but if it starts going up, that's going to put the Fed in a pickle. So the Fed rate cuts is the next thing. Part of that rally we've had recently is investors are getting more and more optimistic that the Fed is going to cut rates starting this month, September. There's a wide range of opinions on how many cuts they're going to do, but the general consensus is the next move for the Fed is cutting rates, not raising rates. So that's good for the markets. That's generally a good thing. Stocks tend to do better and bonds tend to do better when rates are getting cut. So over the next 12 months, I would suspect that's the general direction of rates is down, and that should be a good setup for stocks and bonds. So I'm going to say that's also a positive. If this changes, so if this one gets bad, if the job situation gets bad, they're probably going to cut quicker to stimulate the economy, to improve the job market. If this gets bad, if inflation goes up, they're not going to want to cut rates because stimulating the economy when inflation's already high is just going to make inflation even higher. So the predicament they could be in, I don't think this is going to happen, but it could, the job market gets weak and inflation goes up. So they have one reason to cut and one reason to raise rates, and then they have a tough choice to make. If everything holds up okay, I think their next move is a cut this month, probably 2 or 3 cuts between now and next May. That will be good for the markets. The last thing, and probably the most important thing, honestly, corporate earnings. Every quarter we get earnings reports from all publicly traded companies. They tell the public, hey, here's the profit we made last quarter. Here's the profit we're projecting going forward. And that is really what drives what a stock should be valued at. If you're looking at the value of any company, the stock price, It's really a factor of how much profit do they make or how much profit are they expected to make. So every quarter, we pay attention to what the reports look like. The expectation here was for roughly a 6% average earnings growth through the S&P 500 for the second quarter. It actually came in at about 11%. So the average earnings growth was 11% in the second quarter 2025, which was almost double what we expected profits to be. So this is where the disconnect is happening. A lot of the concern around tariffs, company profits are going to be lower, inflation is going to be higher, hasn't materialized yet. So earnings came in strong. These are all holding up nicely. The Fed's probably cutting rates soon. This is generally a good setup for the stock market to do pretty well if it holds. And so that's what we're watching. I know that's a lot of moving parts, but there are reasons why the stock market does what it does, and these are some of the reasons. So hopefully this is helpful for you to, as you watch the news and you see these jobs reports come out, what does that mean? Strong job market means the Fed's probably going to be more likely to cut. Inflation, if that keeps going up, they're less likely to cut. So those are the kind of pieces of information that the Fed really watches closely. Hopefully that helps you guys understand what's going on. As always, if we can do anything to help, let us know. Thanks.